The number one guiding question that I come back to still to help be a soundboard for our investors as well is like, what's the goal for the money? Is that 100K designed to generate reliable, passive, predictable income? And the growth is secondary, or is it growth because the person doesn't want or need active cash flow?
The Apartment Gurus podcast is brought to you by Greenlight Equity Group, an apartment acquisitions and holdings firm co-founded by Carl York and Tate Siemer, host of this show. We offer you the opportunity to be an owner of cash-flowing, wealth-growing apartments without the headaches of being a landlord. These assets are recession-resistant, risk-mitigated, offer significant tax advantages, and are a great alternative to the stock market. Ready to check it out? Go to www.investwithgreenlight.com today to book a personal consultation with Carl or Tate. Again, that's investwithgreenlight.com. We look forward to meeting you. Welcome to The Apartment Gurus, where twice a week, host Tate Siemer brings you deep dive interviews with the wisest gurus in the apartment investing industry. These experts are sure to create game-changing value and inspiration designed to catapult your business to the next level. Be sure to reach out to Tate at www.investwithgreenlight.com for access to his investor portal and Calendly link. And now, here is Tate Siemer and the Apartment Gurus.
Welcome, everybody, back to another episode of the Apartment Gurus. Got a return guest, a return superstar guru in the making. By the way, I don't mention this often, but I think it's important to know or mention that the gurus and Apartment Gurus is not referring to me, and it does definitely refer to some of my guests for sure. I would say probably on behalf of many of my guests, they are very humble and grounded people and would not be comfortable referring to themselves as gurus either. So I'll just say that, kind of one of my life views, I guess, is that we're all gurus in the making in our own way and in our own worlds, hopefully, or we can be if we want to be. But to me, that's a North Star, right? That's a signpost. And I would say, at least for myself, that work's never done. And I certainly am not at a point of considering myself a guru of life or of apartment investing. But I've certainly had some on the show. There's no doubt about that. Spencer Hilligoss with me here today is, like I said, a returned suspect. One of the OGs. It's been a bit, Spencer. We were talking before we started recording. September of 22 was your debut and only appearance here on the Apartment Gurus. So we've got a lot to catch up on. We were catching up a little before we started recording, but I think let's just kind of jump right in, man. What's been happening in your space in the last it's going on 2 years, but let's say especially year and a half, and we'll frame this, with the listeners and with you, and everybody's aware of this. Like the last year and a half in the multifamily space and commercial real estate and housing in general has been interesting, right?
Right,
very interesting, and really a lot to process and juggle. And in our case at Greenlight Equity Group, we shifted huge on our buy box, meaning that what we're currently sourcing in the way of opportunities for our investors and our portfolio is quite different than what we were sourcing, 2.5, 3, 4 years ago. So Spencer, first of all, man, awesome to have you back.
Great,
really good to see you again.
See you, Tate.
Man.
To your point, a lot's happened, right,
yeah,
in the last kind of couple of years, but also. I have a problem with, attention, ironically. And so I would say that all those very kind words you brought up front are making me blush. So thank you. Good to be back. It's good to see you.
Yeah. No. Yeah. So give us your perspective here on what you see happening market wide. And then I want to talk about how so Spencer's company is Madison Investments. So everybody go to MadisonInvestments.com. I can connect with Spencer there. And Spencer's last name, for those of you listening, is Hilligoss, which is Hilligoss. Sorry, Hilligoss, no R. So Hilligoss, Hilligoss. So, yeah, Spencer, just catch us up, man. Been almost 2 years. What's happened in 2 years for you?
Yeah, and again, it's great to be back, Tate. I think the journey of being a passive investor first is
Yeah.
one where you learn as you fail forward, as it were, right? Same principles that I used when I was in my tech career of 13 years. So just for folks, quick overview. I mean, so these days I lead Madison Investing at madisoninvesting.com with my co-founder Jennifer Mormoto, who's also my wife. That's like its own podcast, of course, as to how one, carves all that out. It works really well for us, and it gives us a bit of what we'd like to think of as like a strategic advantage, because it's holistic, right? Life, financial freedom with your family and our two young boys,
Yeah.
and also just for our business. And the whole lens on this, when you and I talked before, Tate, and now same here, is our lens is one of financial freedom, maximizing mobility, and putting life at the top of our list, of our priority list. And I just want to share that with folks too, because this isn't fluffy stuff that we talk about and you only pull out of a book. This
Yeah.
is hard fought lifestyle. Where last summer I was just telling you earlier, Tate, like we did something we wanted to do for years as a family. We lived abroad in Portugal for nearly 2 months with our kids. It wasn't just sitting on a beach. I mean, it's life, right? You're living abroad and sharing these learnings globally with our kids. We're doing the same thing in 2 weeks. We're going to go live in Croatia and Montenegro over the course of about a month and a half. And all that stuff would just be so pipe dream sounding and crazy if I could go back in time to when I was working full time in tech for 13 years, building big teams and, at fintech companies, financial tech companies. It was 80-hour weeks.
Yeah. Yep.
That never would have worked. So,
Right.
Before we get into kind of the stuff that you and I appreciate, and I'm sure a bunch of folks do about, passive investing, but multifamily investing in the market and what's changed mightily in the last 2 years. I just want to share that with folks because that is ultimately why we are all doing this. It's certainly why I'm doing this along with Jennifer is carving out a different path, man, because it was broken before. The equation was broken. 401ks were looking good, dual incomes in a household, chasing that Silicon Valley equity dream. But in the end, something had to change. And so we changed a lot. And so before we get into the nitty gritty of investing.
Well, I mean, I love that we're starting out with this because this is the context, right? This is the context in which you do everything else. So from this point forward, everything else is kind of details. I mean, you had 13 years in the tech sector. Is that what you said?
Yeah. I mean, never was the plan. I mean, my dad
Right.
was a broker for 30 years in residential real estate, which is kind of why I ran screaming into tech. So, I didn't understand that so many folks don't like that. Like I thought brokerage meant real estate.
Right.
And I thought the only thing you do in actively getting close to real estate is selling homes, buying homes, and so I got exposure to that when I was very young. Also got exposure to what happens when a family with a single active income, goes through a downturn in a bad way, lost a lot of family in a very condensed period of time. His business crumbled, like all this stuff that later bounced back in our family growing up. But I bring that up because those principles very much stay close to me today about what not to do, and building some income streams around our family, And so, back to your earlier question, Tate, like this journey started with us buying some rentals locally. We call that like phase one. We were working full time.
And
Here in California.
Remind everybody where you are in the world. So when you say locally.
Yeah. Sorry. Live in the Bay Area, California.
Yeah.
Lived in Colorado for about a decade, but we've called California home now for over another decade. But we bought a local rental here. First thing we bought in real estate. Thought that was passive. Paid $430K for $200 a month in cash flow, which is not a cash flow win.
Right.
I call that learning. We still have it.
Could be an appreciation win at the end of the day for you. Hopefully.
Hugely, yeah. It's gone up in value, but not like you can't go live in another country on that $200 a month. Right?
That's right.
And, phase two for us, as it were, was we got up to 5 single family rentals in the Midwest. Great economics going in, buying $60K a pop properties, which is mind blowing, making $250 a month in cash flow, which is killer for a cash flow play. But then you realize it's semi-passive at best because you are still managing the manager, even though you're paying your 10% a month of your income to that property manager. You manage them. The final phase, as it were, looking looking at hindsight, it sounds so clear, but it was not clear at the time. We were working our butts off while also doing this on the side. Like we invested in multifamily syndications, and we invested 25K in our first one as LPs, and we've put in over 7 figures of our own wealth over the past 7 years now into a bunch of multifamily deals across the country, many different operators and sponsors, self-storage, some mobile home park, and a bunch of our niche assets. And it's like that has enabled us to hit our financial freedom numbers that we set out to hit years ago, And so I just think that landscape is always helpful just to share because folks kind of look at it like, oh, I don't know how you ever got there, and be like, it wasn't some magic wand or silver bullet or whatever analogy. It's really learning voraciously. And putting in the hustle on the nights, weekends, mornings, and beyond. And then and only then does it become more passive.
Yeah. So much to unpack there too. And, so much to love, right? Like, and I think the one thing that you mentioned, you mentioned the voracious learning and the hard work and, just picking a lane and like, I'm paraphrasing heavily here, but picking a lane and like digging into it hard and figuring it out and how to succeed in it. For me, what I'm interested about was kind of the guidepost along the way for you. So your dad was a residential broker. How did you get exposed to the vision of multifamily syndications?
Yeah. The principles I learned back then weren't really wrapped up in any kind of investment bow. It was very transactional. And I learned a lot. In hindsight, I really did. And his business ended up thriving after a major downturn. But I was working for companies like Intuit. That was the first big company I worked at. I was thrown into managing teams of people over 200 when I was like 26 years old. That was way more responsibility than I was ready for. But that's how you learn. Across those 5 companies, I didn't really get the fact, besides dumping money into a 401k, that diversification matters. Like truly other income stream diversification matters. Great. Two W-2 income streams is awesome, but I was very fortunate. A mentor of mine in the corporate world, he nudged me to go join the last company I was with. I left in October 2019, and it was a lender. It was a fix and flip lender and tech company. It used to be called Lending Home. Now it's Kiavi. They do the most fix and flip loans in the country at the time. I didn't know what the heck that meant. Like honestly, Tate, like I didn't know what loan to values meant. I didn't know how to look at a scope of work, what an exit strategy was, all this stuff. But I was in charge of going in and turning around a team and hiring a ton of people and doing it well. And so I had to learn that business. And what I learned was, wow, on the other side, inside, looking at how many zeros were attached to these projects, I was sitting there going, this person out in Pennsylvania is doing what? That person in California is doing that? And I was sitting there going, well, clearly they're on to something. I cannot swing a hammer at all.
Brother, I'm so right there with you on that one. Don't put a hammer or a screw gun in my hand unless you want something to get broken and have to fix it later.
Right. Yeah. I'm very grateful for YouTube.
Right. YouTube University for sure.
And I'm very, secure in myself to say Jennifer is a hell of a lot more handy than I am. And so all that said, I do know operations, predictability, forecasting, team management, partnerships, all these things I gleaned from a long 13-year career. And I'm not the guy who digs on the W-2 career either. I think there's a lot of that flies around. I had a good experience overall at W-2, but I learned a lot.
Yeah.
But
and by the way, that you mentioned deploying 7 figures into multifamily syndications. Some of that had to have come from the W-2 space, right?
Oh yeah, lion's share. Yeah. And we were fortunate at first. Full transparency. It's like we had gotten great income. We had, stored up a lot. We had also been fortunate. We bought our house way earlier than a lot of people in the Bay Area, in our peer group did. So
what year did you buy?
For us, it was like 2013.
Yeah, dude, that's like perfect timing on that last coming out of the last 2011 to 14 or so was really good window there.
I believe we had 3 refis and 1 HELOC, and that certainly helped too. Along the way, you could pull equity out of the home, and so we were fortunate to have executed on that, so we could tap income from W-2s. We could tap equity capital from the home over time. And also I consolidated 4 separate 401ks that I had maxed out or had done very well on for 4 companies. Because when you work in tech startups, you don't stick around that long. 3 years is a long run.
Right.
You're not a 40-year lifer at these places, right? So I consolidated those 4 into a self-directed account. So I've invested with all those different sources over time. But all that said, you kind of just have to take action at some point. And I was 4 a.m. to 6 a.m. devouring over 400 podcasts in an 18-month period while going in and doing all that work at my day job, and then also reading something about like 24 books in 18 months, which became procrastination. That's just
that's such an interesting thing though, because like people hear that, like, read a book a month or read a book a week or whatever, and it sounds like something to aspire to, right? And there's obviously huge payoffs in doing that, and I think you're a testament to that. But you speak to the other side of that too, which is anything that's keeping you from taking massive action is ultimately a distraction, even if it's something that you think is sharpening the saw. I mean,
that's right.
Sharpening the saw is massively important, right? And like, you wouldn't be who you were without the 400 podcasts and the books. But you make a good point about it, and for listeners, if take a look, like, is any of this stuff YouTube University? I can point a finger right back at me on that one. Like, I can definitely procrastinate in YouTube University because there's so many shiny objects and distractions there. And
right.
It can also be this math. I mean, I don't think side note, I don't think there's anything more important on the planet right now than YouTube. Literally anything and everything that you want to be exposed to in any way, in the way of human knowledge, data, analysis, ideas, encouragement, you name it, it's there, right? Spirituality to business to
that's right,
to family to relationships to how to install a replacement stereo in your 2012 Toyota 4Runner, like I have. So, I mean, all the how-tos are incredible. Everything about it's incredible. And so one of my very first recommendation on my tech sheet that I have a free tech sheet that I give people that are just a number of recommendations is get a YouTube premium account. Yeah. I'll just say that, I'll throw that out there to you guys right now. Hopefully takeaway for you guys. It gets you ad free, which is, I think, massively important. I mean, 10 to 12 or something bucks a month to not have to listen to ads. But more importantly, it gets you some premium features like being able to listen to audio on YouTube when you're not in the app, right? So you can be on your phone listening to an audio and be doing something else, or on your computer, same way, obviously. So anyway, side note there, little unsolicited, uncompensated promo for YouTube.
Same here, man. I'm not an affiliate, but I'll say we definitely have YouTube Premium for that reason.
Yeah. And there's the playlist features. There's other big things that I think are an important part of Premium. So, okay. So I guess what I'm still looking for is, like what spurred the inspiration into the multifamily syndication? Because from where you were, you could have gone. You were in single family. Jennifer was cooking with swinging the hammer. You were doing well, and I'm sure you saw a lot of the shortcomings of the single family space, like most of us have. Right. People listeners have probably seen the same thing, which is why they're in a podcast called The Apartment Gurus. So, what did you see? Like, how did you catch that vision?
Yeah, I would say probably 3 bullets on that one. First and foremost was realizing on one of our rental properties we had out in the Midwest, of those 5 that we had there, when your occupancy is at 100% because it's full, great tenant that you got in there, all of a sudden something changes, life event, whatever, and they leave, your occupancy goes from 100% to 0 overnight. Point blank, that right out the gates.
And if they're gone for if that's empty for 2 months or 6 weeks, that's 10, 15% or whatever, 10% of your annual income right there.
That's right. Yeah.
Or margin. That could eat your margin way up. Yeah.
No, the turnover cost. Yeah, absolutely. Yeah. Well, and you just nailed it. I would say that turnover cost for that $250 a month in cash flow on average that I mentioned earlier, Tate, across those Midwest properties, 1 or 2 of them, those economics went out the window entirely for a given year because of that reason. Yeah. If you invest in C-class neighborhoods in particular, you're going to turn over that person, and the costs are going to spike. So I digress, but you're absolutely right. Bigger properties, we all talk about economies of scale, but I will also say that occupancy has 400. If it's a 400 unit, really big place, one person leaves, 399 other people that are there
Right.
being taken care
Drop
of.
in the bucket. Yeah.
Yeah, drop in the bucket. 100 units, same deal, all the way down to 20 units, same principle, right? So that was it. I would say beyond that, though, investing passively, and what does that really mean? For where we were at, Jennifer and I, at that point, and also where we're at still now, rentals and outright rental ownership, like holding title to a property, is actually a great longevity wealth building tool. However, it is semi-passive, and I will stand firm on that opinion for until the end of time.
Would you say that? Are you saying that even as an LP?
Absolutely. Yeah. Investing in a rental property, like in buying it, it's a good wealth building tool, but it's semi-passive at best.
Yeah. Because as a limited partner, you're still making a choice at the end of the day, how you're deploying, and that takes due diligence. And it's not like there's brokers out there that are picking these deals for you necessarily. Although I guess you could say a fund manager can kind of fill that role, but yeah, you're doing due diligence either on the deal itself, on an individual deal, or the fund manager. And then you're keeping track of stuff and keeping your finger on Yep.
Well, and to your point, like, why does it get us fired up, and why is it aligned to our goals long-term to invest as LPs? It's comes down to, how does one vet the who? I mean, and you just, took words right out of my mouth in a good way on that one, Tate, which is like, there's killer operators out there. I mean, you're an active operator yourself, right? And like, it takes experience to go out and do this stuff. And going out and doing it, though, is about aligning as an LP, as a passive investor, going out and aligning with the team that has done it. They've got repeatable business process. And so we have like a 5-part vetting framework that we've used and honed over time. And, we've done this now on over 53 individual deals over time. And like, all that to say, you got to look at the team, you got to look at the track record within there, including, do they have repeatable business processes? It sounds a little funny, but we look at values, and there's behavioral interviewing stuff that we'll do for that.
That's great. What do you, I can geek out on that stuff. Do you have a specific test that you guys like?
Some of the quant stuff, you can look at a list of assets purchased over time on the track record, but on the behavioral stuff for values, testing for values, anyone in the corporate world who's been hiring regularly for the past 5-10 years is going to be familiar with, like, basic stuff at this point, but for like behavioral interviewing and like asking someone, tell me about a time, questions. Tell me about a time when you had to evict a tenant. Like, how did you work through that? What was the circumstances? One of the ones that I think is a more fundamental one before that, though, Tate, if I want to get a sense of values, I have asked actually quite a few folks, what is your philosophy on tenant experience in your buildings?
Love that.
Well, and there is no, textbook answer for that.
Right.
And what we're looking for, and I'm looking for, is like, have they thought about it?
Yeah.
And
right.
I think what would be shocking for most people, and it's still surprising to me, is typically they haven't.
Right.
And if they just say yes, well, that's not enough. I would just like to have them tease that out. Like, what are ways that they've gone to create an experience? We're not talking about putting in amenities. We're talking about just taking care of the human beings that are in the building, because we're all capitalists here. We're investing because we want to build our wealth, financial freedom. Of course, at the same time, though, we don't want this to be something where it's purely a financial investment for the betterment of the investor. We want to know we're investing in something where people are able to live and and do so comfortably. So that's the type of stuff that we tease out on the values front.
Yeah. Made me think of our vivid vision that at Greenlight, and our core values, right? And one of our core values is investors and residents first. Like, we know that if we take all the residents in our sphere, which right now about 800 families and or single people living in our properties, and then all the investors in our sphere, both active investors and investors that will invest with us in the future. If that's who we are serving all the time, we know that we're going to be successful and be in alignment. And so for me, it's a matter of access to safe, clean, orderly living that promotes a sense of community, a sense of responsibility, a sense of thriving, a sense of ownership inside of our tenant base. And
It's awesome.
yeah, and so, but I'm not patting myself on the back like, hey, I got the answer. You know, like, but it is something that there is so much power in the intentions that you set in life in general, and in my opinion, and this is one of our most important ones. And I think it shows, not always, you know, property management in particular, asset management is not a perfect science at all. Right. And you're dealing with human beings and human lives, and you're a human being, and so is your property manager and your regional, and it's not a game of perfection. A lot of times it's a game of chaos management, or, you know, even dealing with forest fires, or you know, fires that could become forest fires, right? Like, so yeah, it's a to me, it's a matter of just responsibility. It's like the Spider-Man line, to, you know, to much is given, much is required, or much is expected, or much is, you know, the sense of responsibility that we have to play the role that we play in our residents' lives. It's huge.
And to your point, I mean, often I see that it does play out positively on the economics. It does play out positively on the operations, right? I mean, occupancy levels stay higher, you know, all those things about, you know, crime locally, like all those things played out over time do manifest. So I think that's awesome. That's really cool.
That sense of ownership, if you can somehow instill that in your residents, like, this is theirs, right? Like, you know, and then it's so much like it's taken care of by them, and as it should be. Not that they're the only ones responsible for the quality of the place, but when you have that buy-in from residents, it makes their lives so much better, which at the end of the day is the best recipe for success for everybody, and including our investors. Totally. So yeah, it's kind of a dual North Star for us, if you will, our residents and our investors.
No, that's awesome.
Yeah. So I'm glad you brought that up. That's kind of a key thing. We don't talk about that a whole lot, honestly, on the show. So, yeah, that's good stuff. So Spencer, I love having, you know, in your case, you started as a limited partner, and then you're now, you've got a few funds, right? How many funds do you guys have in place?
Yeah, well, you know, so up until last year, and I know we chatted about this offline, not just in our last conversation, but just chatting today as well. You know, for years, we actually did not create our own fund by design. That was our business model, and I was registered with FINRA. You know, we also I've been GP in deals in the past, but this year we actually launched the first that I am. You know, we are, Jennifer and I, the fund managers on. So like we just launched our very first one, and we're very excited about that because it's something that we have done very deliberately. We've been passing on deals like crazy for the past 9 months. You know, it's been a long haul in terms of just, you know, looking across the landscape and looking across the desk of different deal flow and sharpening the pencil, because the economic climate has changed so dramatically. So that's, you know, that is, you know, fewer but better is really the mantra when it comes to, you know, what we're looking for and considering. And frankly, just to mention it as well, the most common conversation I find myself in with other LPs right now is like, you know, looking across like how to navigate the market. Because, you know, if you and I were to be looking at deals 2018, 2017, it's a simpler equation, right? At least in terms of like looking at a multifamily deal, you could look at a deal and say, well, this as an LP, I can see that wonderful looking 2x equity multiple over the course of a 5-year hold period, with a compelling cash on cash return during that hold period. And then at the end, an equity check that comes out with some great tax benefits, including some depreciation losses. Like, that all sounds great.
Hopefully that's what we're still doing. Like, I gotta say, like,
and they
just kind of went through the checklist of like what we are still shooting for with our deals, but it's not like it was back then at all, as far as inventory, amongst other things.
Exactly.
Right? And debt, of course. Yeah.
It's just harder to find, right?
Yeah.
And so like, and you're living this and working through this, is that those deals are there. And in fact, right now, in many ways, they're even better
Yeah.
because they're better than they've been in years because of the economic moment. So filtering through all those that are coming up through that haystack and finding those deals is tougher, but when they come through, they're great.
Yeah.
And so
Yeah.
that's really where I just wanted to provide some context for folks that might be, I don't know if they're early in the journey as LPs or if they're sitting there going, man, the deal flow has been hard to see, but it's there.
Yeah.
I just have to wait longer.
Yeah. Right. Yeah. So talk about how you guys transitioned into a fund model.
I'm an operations guy, and Jennifer and I both had our stints in operations and scaling teams and stuff within the corporate world, and so it's familiar territory for us. It really just comes down to patience and being methodical, and looking for the right structure that is very LP friendly, so we can invest in the right deal along with our fellow investors in our club. We can invest six figures and they can put in another check of their own that they feel really good about, and so that's.
Yeah.
That's about finding the right markets that you want to focus on now. That's about finding the right teams and very deliberately looking at kind of sitting on the side of kind of the bank right now. Looking at a lot of private credit, preferred equity stuff as well. It's been a key focus. So
okay, so you have funds or a fund that will invest as a pref equity investor.
Correct.
Yeah. Okay, gotcha. Talk about the conversations that you had with your investor base when you went from investing in individual deals to a fund. Like how did you frame the fund opportunity? How do you still talk about it to this day?
Yeah, well, and to be clear, like we are going to put together like a blended fund, but right now we just put together like an SPV, and so it's like we're doing just a focused SPV. We'll probably do 1 to 2 more this year.
Okay.
And it's focused on pref equity, and so
Okay.
that conversation is just way more natural, I think, than we ever could have expected or hoped, because in the end we've known so many of these investors. I've onboarded all of them myself. Every single team out there, whether they're a sponsor, whether they manage a fund, whether whatever role they play in this wonderful industry that you and I appreciate, Tate, like there's different ways to build an investing group or build relationships with people. And the way that I have chosen to do it since inception has been to do it kind of the old fashioned way, which is, we don't have some massive funnel, big advertising campaign, paid ads and all that. I've gotten to know them each individually. Our number one source of new members is by referral. And as a result, there's a trust level built. So I would say it's pretty organic conversation so far. Still just working through what's the difference, like what are the technical differences of investing directly versus investing in a fund that gets more preferred terms for fellow investors that then invest in a deal, or a different fund. So those questions are actually quite reasonable to work through, because ideally we have the relationships with these folks that we're sharing it with.
Okay, so just so I want to make sure I understand. So when you say you've done SPVs, special purpose vehicles, right? Is it
correct?
Yeah.
Some people say SPEs, some people say SPVs.
Yeah. So when you say you've done that, are those specific to an individual deal, or how do you have those set up?
Right now, set up to through SPV invest into another fund that we have taken 9 months to curate and vet and do extensive due diligence on. But there will be 1 or 2 more, most likely, that will end up being into individual deals. But it's just got to find the right deals.
And will those be investing in multiple deals or single individual deals, or do you know yet?
It depends on what comes across the desk.
Okay. That's interesting. So the model right now, at least, is somewhat determined by opportunity. You find in this case, you found a great fund, and you're like, let's vet it, let's make sure it's awesome, and then let's put together an SPV, and you're syndicating into that SPV, right? You're bringing your investors into the SPV. That SPV takes a position in the fund,
correct?
And you get probably a preferred position in the fund, meaning you guys, your fund gets a little nicer split, probably somewhat of a higher pref payment, sometimes anyway.
Yeah. Better split.
Yeah. And so, and you as a fund manager, you're also investing in these yourself with your own funds. So you're making some money there, and you're making some money on the arbitrage, if you will, sometimes with the split or the pref payment. Do I kind of have that all pretty much right?
All pretty much right. I think the one thing that's noteworthy is that by design, it's not just about trying to make a compelling split for arbitrage purposes. I don't think we'd be doing it if that was the case. I think it was also about uh, truly, providing preferred terms that are even better than going direct. And part of that means the arbitrage is not as exciting for us. It's enough,
Yeah.
right? It's
Yeah.
enough.
Yeah.
And that is something that our members, I think, expect from us at this point, and we want to deliver on that.
Yeah, well, and when you have the capital and the ability to invest yourself, like it does so many good things for you.
Right.
It adds credibility, it adds skin in the game. Your investors love that. Plus, it gives you the ability to actually make more money on that deal. You're not just making
Right.
the fund management piece.
Totally.
Yeah, yeah, that's good. That's really good. So talk about your buy box a little bit, like in terms of, when you're looking at, like, let's take this fund that you guys are about to invest in. What's their asset class? What's their niche, if you will?
Yeah. Well, I think first and foremost, I am that kind of nerd
Mhm.
who likes to build out a spreadsheet and take a lot of time for research and due diligence. And so, really, this whole category that's gotten big, and you can attest to this, as we've seen over the last 18 to 24 months, Tate, as the market has pulled back on the banking side.
Yeah.
Like lenders are way tighter on what they lend, and they charge a lot more for when they do. So something has to fill that gap, and that means on new acquisitions as well. In layman's terms, that basically means like I can now invest to a different part in the capital stack and get decent cash flow and returns. I'm not going to get some of the tax benefits, of course, that I love. I greatly love and appreciate
Yeah.
every tax season when I invest in a multifamily deal, and I want to see that K1 Schedule K1 tax form with good losses. But the purpose of this private credit exercise was like, okay, there's debt funds popping up, there's private credit funds popping up. Sometimes it's for one deal, sometimes it's a big fund. And I was looking across going, this is pretty overwhelming. There's just so many that popped up out of the woodwork. So looked across the market with criteria of looking for teams that had, you know, 10 years, if not close to 10 years of experience, in the space, not just in real estate, but like actually doing credit fund management. In one of my favorite phrases now that I would say, if it wasn't a favorite phrase before interest rate spikes, it is absolutely a favorite phrase now for due diligence, which is audited financials. Audited financials, hell of a good term if people are doing due diligence on a fund out there.
Yeah.
Is a third party tax, or is a third party firm doing audited financials on a recurring basis, annually or otherwise? So track record matters.
Yeah.
Transparency on financials matters, and frankly, seeking cash flow, because not everyone wants growth. Every investor is different, and I think that the guiding question, just to finish off this diatribe, without getting too wordy here, Tate, is that the number one guiding question that I come back to still, and I help be a soundboard for our investors as well, is like, what's the goal for the money?
Oh yeah.
Is the goal for the money is that 100K designed to generate reliable, passive, predictable income, and the growth is secondary? Or is it growth because the person doesn't want or need active cash flow? Maybe they have great income W2 or maybe they've already exited their own small business, or big business. Those are the two real profiles. And so when it comes to looking at private credit and debt, that was really the intent, is like looking for more liquidity, looking for more cash flow during the hold than necessarily the thing that I know and love and will continue investing in as well, which is just great multifamily deals. Because the private credit fund has the cash flow, it has diversification, it has more liquidity in a more secure spot. But what it doesn't have is the tax benefits.
Got it. So
in
so that fund is investing as a lender in real estate deals. Are they taking, is it first position, second position? Like, what kind of position are they taking?
We did look at some first position funds. We looked at senior lender funds, senior loan funds, first position stuff. Looked at single family stuff. This one is always going to be either mezzanine or bridge or pref or preferred equity, and it's going to be secondary.
Got it. Awesome. And so I can't help but let my green light deal making machine creep in here a little bit, but
Hey,
this is going to be a little bit of a loaded question, but how do people like engage with you? And, somebody that has an opportunity, has either a deal or kind of an ongoing niche in an asset class that they're looking for long-term equity partners with, like how does that process get started? Is it through your website? And then how do you kind of go from there?
Yeah, I mean, folks can always reach out, MadisonInvesting.com. We do have operating partners, right? Like, so our fund is an SPV into a fund. So we aligned on underwriting criteria with the managing operators. And so, but I've made introductions. So folks can reach out, or they can go to the website, sign up there, or just email me, Spencer@MadisonInvesting.com.
Cool. Love it. What's next for you guys, Spencer? First of all, if you haven't checked out MadisonInvesting.com, go there. There's beautiful pictures of Spencer and his family, 2 beautiful children, man. How old are they, by the way?
Yeah, we got to update that one. Now they're 10 and 6. So they're a little bit older.
Yeah. So these Europe trips, man, they're loving it, huh?
We were wondering about that. We're like, are they going to, groan when we say we're going to go do this again this summer? And we're leaving in 2 weeks to go get on a 14 or 15-hour flight. And
Yeah. Right.
They're pumped.
That's awesome.
I appreciate you asking.
That's so awesome. Yeah. And I mean, what an age, right? Like because they're at the age where they kind of get it, like what a big world it is, what a diverse world it is, like what a cool thing is that you guys are doing. Hopefully, I mean, to some degree, I'm sure it's the water they swim in a little bit, like we all have. But I'm sure that they also have this massive appreciation for what a unique life you guys have built for them and for yourselves. And it's just amazing. It's or towards the beginning of the episode, the concept that came to mind that I wanted to bring voice to is this lifestyle by design, right? Yes. I think it's why so many people are in this business that we're in. Time freedom, money freedom, location freedom, however that looks for you, whatever those requirements are. Actually, let me ask you this before. I've got a kind of a couple wrap-up questions here, but yeah, when you look at financial freedom, because that was a concept that you brought up early in the show, what does that exactly mean to you? What does that look like for you? Like for you to have declared, we're financially free, we can pull the plug on the Bay Area for 2 months and go live in the most beautiful country in Europe and Croatia, from what I hear. Like what does that look like? What's financial freedom mean to you?
Yeah. Try not to throw out too many buzzwords, but I'll say, intention, above all else, like living intentionally, with maximum optionality, so said another way. I think before getting financial freedom, so many of us, myself included, sat there and go, oh, when I get there, I'm going to sit on a beach. And in the end, if anyone has the opportunity to work their butts off and get to that point, and I say this very self-aware, I know I might sound delusional and lofty and full of myself, but it's not the intent. This is sincere, is like, they'll get there and realize that's super boring after a very short period of time. And,
sure. Give it a week or two. Yeah, absolutely.
Give it a week or two. But also, I think we're all here to do something that is fulfilling for us. And really the most sustainable way to do that is by also doing something that serves others. And that can be nonprofit wise, that can be business wise. And that's why, Jennifer is on the board of a financial literacy nonprofit that helps, kids and teens in the Bay Area. But also that is our financial literacy focus, charitably, so for the philanthropic stuff for us. So all of that, the longer answer than I meant to give. But it really ties back to financial freedom means the choice to do something at a higher level that serves some kind of higher purpose. And that doesn't just mean business. That doesn't just mean nonprofit. That means showing up as a dad.
Yeah. Heck yeah. Yeah. So those are like the fruits of the financial freedom piece, right? Like the ability to live the life you want to live, show up as a dad, be intentional, and the intentions in the causality for sure too. Is financial freedom for you? I mean, I think the classic definition is just where you're, and I heard this yesterday. So, and I forget, I think it was maybe Hormozy, where your passive income simply exceeds your living expenses. Is that a good enough definition for you?
Yeah, I think it is.
Yeah,
but I think oftentimes what people realize, because we hit our financial freedom goal, we originally set it in 2016. We hit it in 5 years. But then you realize, oh, it's boring to do nothing. And also you can do more. You want to add value in work. And so what does that mean? Oh, you probably want to raise the goal.
Yeah.
And so it is a cycle, but I would agree with that definition.
What's the new goal look like after you guys got to financial freedom?
I mean, really, it's a summary of everything that we just talked about. It's like, how do you flip work as the priority to suddenly have life and family and health? Big emphasis on health as well. Not working 80 hours a week, because frankly, this is not a recipe for long-term success as a parent, as a friend, as a husband, all those things. You got to take
as a
care
person.
of
Yeah. 100%.
Oxygen mask first, and then do that sustainably over time. That's the goal.
Yeah. Yeah. Awesome. You mentioned meaning, or at least maybe you didn't mention it by word, but I think you did. But that's what kept coming up for me when I was listening to you too, like the importance of just the being connected to being connected to a sense of like purpose and meaning and kind of service, I think was the word you used, serving others in the world. I hate to bring this up because we're right at the end of the episode, but I want to bring it up. So I guess I don't hate to bring it up. To me, this whole the meaning piece with the oncoming presence of massively intelligent artificial intelligence is going to be a really interesting conversation moving forward.
Oh, yeah.
Because we as human beings are about to be, in terms of our function on the planet, right? And what I mean by that is mainly professional, like what we go to work and do or do in our home office is about to be transformed in huge ways across the board. It will affect everybody and everything we do, in my opinion. And it's gonna bring into light like what it truly means to lead a meaningful life, because the things that we have found purpose in it, and there's nothing wrong or bad about this, but they've often been like utilitarian, if you will. And in that regard, getting up and going out and milking the cows, which that used to be a huge part of so what so many of us did, or going out and pulling weeds and gardening or farming, or going out and hunting and gathering, like all the things that our lives we evolved around doing in the name of survival and sustenance and procreation. Like that's going to all essentially be like a given, right?
Yeah.
Based on this incredible like displacement of costs on goods and services. So I'll just let's close it up with this, because we're bumping up against it here. But AI for you, have you integrated? Are you using ChatGPT for stuff? What do you see there?
Yeah. Oh my gosh, you had to go there. That's such a fun, deep topic, Tate.
I know, right? With a minute left on our clock. Yeah, I know.
Back out here a little bit. Yes. Yeah. I mean, we certainly use ChatGPT, for just basic stuff, day to day. When we're finding one's copywriting, but we do write our own stuff, of course. But yeah. I think the short answer would be yes, do use it. Agree with everything you said just now, in terms of what is coming and what's already happening now. Ultimately, the question that we have started to talk about in our household is also like, how do we prepare our kids for this world that we're describing?
Yeah,
and
I know.
I think about that too much, but I would say it also inspires me to ensure we are on our game, and that means that we are helping nurture and educate and open the worldview to our kids, and through whatever means we can, because in the end, humans are going to crave connection, whether they have AI in their lives or not.
Yeah.
That's the bottom line, in my opinion. And I think that connection takes many forms, but some people get that spiritually, but they still need it with a human. And an AI is not going to replace connection fully, but it certainly is, in a professional sense, helpful for folks to start now thinking, what am I doing to level up my thinking and integrating these tools into my day-to-day in my life? Because it ain't going anywhere. That's for sure.
Yeah. We're just scratching the surface, in my opinion, on this stuff. And And to me, it calls in. I love that it speaks to the same thing in me, where it calls forth on me to bring my game up, raise my game, right? And bring my A game every day, because that's what it's going to take, I think, to like successfully navigate this massive amount of transformative, like we're going to be in a technological vortex of constant change and evolution, and the unknowability of the implications of that is just real. It is what it is. Even the Elons and the Sam Ackmans and the developers of the world that are on the very tip of the sphere and this stuff, they say the same exact thing. There's like the unknowability of 5 years out, 10 years out, 30 years out. There's no way of getting around that, because we're going to be coexisting with something that's 10,000, 100,000 times more intelligent than we are. So what does that mean? We've never had that before. And to me, what it means is, like, number one, living your best life now in the moment. And number two, it means like really discovering what your truth is, or if you want to say what your meaning is, or your mission, or your purpose, like what's really important to you in life. Because it's going to take, I think, knowing that and intentionally focusing on that and creating it to achieve it, really. Because amongst other things, even now, tech has our number. Tech knows the algorithms know how to hook us and keep us. And that's just going to get more and more the case. And so instead of zombieing out to those dopamine hits that we get when we get a like on a post or whatever, like, staying grounded, staying with what matters, what really matters the most. I love how you spoke to connection, Spencer. It's beautiful. And it's what makes humans human. And, what those things that will differentiate us from an artificial intelligence or an AGI or whatever it ends up being, those are going to all of a sudden become very important and in focus to us. And some things that we took for granted about being a human being, all of a sudden it's going to be like, that's unique, and it's important. So awesome stuff, Spencer. Remind everybody how to reach you and how to connect with you.
Yeah. And thank you again, Tate. This has just been awesome to reconnect.
Yeah, you bet, man.
I didn't know we had AI in store, so that was exciting.
Yeah, I know. I couldn't help it.
No, it's great. So Madison Investing is our company and our investing club. So our URL is at madisoninvesting.com. Folks can reach out to me that way and just sign up for the club. All I ask is people are reasonable human beings, and that we can connect and have a conversation.
Yeah. Awesome. Great stuff. Spencer Hilligoss, everybody. Thank you, Spencer. Thank you, listeners. Love you guys. It's so fun to get to bring these jam sessions, as I think of them, to you, where Spencer and I just sat down with a guitar and a drum set and hopefully spit out something worth listening to. And that's the analogy going back to my band days in college and high school. But love this, Spencer. Thanks a ton, man.
No, thank you, Tate.
Yeah.
I'll talk to you soon.
And thank you, listeners. We'll see you on the next episode. Take care, everybody.
This has been the Apartment Gurus with Tate Siemer. If you enjoyed this episode, be sure to subscribe and leave a rating and review on your favorite podcast platform. To contact Tate, go to www.investwithgreenlight.com for access to his investor portal and Calendly link. He loves to hear from you and thanks you for being a valued listener. Just a reminder that you are the guru. See you on the next episode of the Apartment Gurus.